To talk about profit. A lot of clients come to us feeling deflated because they've been in business for a few years and they're making sales and collecting cash, but their accounts show that they're making a loss. And this can feel disheartening and also unaligned to how they think the business is performing. And the majority of the time, this is because the cost of sales figure, also known as the cost of goods sold or COGS, is too high. If the cost of goods sold figure is too high, profit will be too low. I've written a blog on how cost of goods sold affects the profit, but I also wanted to come on here to talk about how getting COGS right is so important for businesses that sell goods. If you have a service-based business, there are other things to worry about, but for a business selling goods, getting the cost of sales figure right is vital to understanding your finances. So first of all, what is COGS? Well, COGS is a formula, and the formula is opening stock plus purchases less closing stock. So getting the opening and closing stock figures is vital in ensuring that COGS is accurate. If, for example, closing stock is too low, COGS will be too high, meaning profit will be too low, and that's not what we want. This means it's really important to get the value of inventory right. So we need to know what inventory is. So inventory is another formula. The formula for inventory is quantity of stock multiplied by the cost of stock. So at the end of the accounting period, you really need to find out the quantity of stock on hand, which will involve checking inventory systems and possibly a physical stock take to ensure that the quantity is accurate. And then the other side of inventory is to ensure that the cost per unit is accurate. So once you know the quantity of stock, you can find out how much each unit of stock costs. Now, you may have a separate spreadsheet or an inventory tracking system that helps keep track of stock by SKU. Hopefully you do, because this will make your life a lot easier. So I now want to look at two examples. So two examples of COGS. One where COGS has accurately been accounted for, and one where COGS has not been accurately accounted for. Because I just want to highlight really the impact that COGS has on your profit and loss statement. So we're just going to go down to gross profit, so we're not going to go all the way down to net profit, but assuming that a business has revenue of £500,000, and this business accounts for their stock really, really accurately, then we will have the cost of goods sold formula. So that is opening stock plus purchases less closing inventory. That gives us our total COGS. In the first instance, the accurate accounting method, the business had revenue of 500,000 and cost of goods sold of 150,000. So that gave the business 350,000 pounds profit. You can see there that the opening inventory was 100,000, purchases during the period was 600,000, but then crucially, the closing stock, the stock on hand, was 550,000. Now this is sitting in the business's warehouse. It's ready to be sold next period. And so for that reason, we are going to reduce cost of goods sold by that inventory on hand. And we're going to show that as an asset to the business. Now let's look at a scenario that we see time and time again. Whenever new clients come to us, we regularly see that cost of goods sold has been inaccurately accounted for. So in this example, same assumptions. So revenue is still 500,000, purchases still 600,000. However, no closing stock journals or opening stock journals have been posted. So that means that instead of having total cost of goods sold as 150,000 like we saw previously, we now have total cost of goods sold as 600,000. And you can see by doing the maths there, 500,000 less 600,000 means that under the inaccurate method, the gross profit is actually a loss. The gross loss is 100,000. So that's the difference. That's how important these cost of goods sold journals are. Like I say, I've written a blog on this and I've included some tips on how you can increase your margins, so how you can reduce your cost of sales. However, this is definitely something that we specialize in. So if you have a business which sells inventory, so if you sell goods and you are struggling with your profit and you think that you are doing better than your numbers suggest, then I would definitely recommend looking at your cost of goods sold. Now, this is not necessarily so straightforward. So if you need some help with it, then we'd be only too happy to help.